Roundtable. My name is Kim. As we approach the final quarter of the year, investors are excited to know how they should position themselves in the market for the remaining of the year and 2025. Whether the rally in the Chinese market will continue, the US market is now reaching record high, whether the rally will continue as well. A lot of questions, among others, will be addressed in today's discussion. We are honored to introduce three speakers today from different asset management companies. We are honored to introduce Puan Nazifah binti Muhammad Ashad, the head of equity investment, BIMB Investment Management Berhad, together with Mr. Lee Chun Hong, the chief investment officer, equities from Principal Asset Management Berhad, and finally, Brian Yeo, senior equity analyst, RHB Islamic International Asset Management. The first speaker is Puan Nazifah binti Muhammad Ashad. She's the head of equity investment, BIMB Investment Management Berhad. She joined BIMB Investment Management Berhad on 8 December 2023. She's a highly accomplished professional with more than 18 years of cumulative experience in the financial investment industries, specializing in equity and research analysis for both local and foreign equities. Her career is marked by a diverse range of competencies, including managing private mandates, ETFs, environmental social governance investments, unit trusts, and proprietary investments with cumulative asset under management exceeding 7 billion ringgit. Prior to joining BIMB Investment, Puan Nazifah held the position of Senior Fund Manager at MIDF Asset Management Berhad. Her extensive career has encompassed positions at esteemed institutions such as ValueCap Sdn Berhad, Pemodalan BSM Berhad, Syarikat Takaful Malaysia Berhad, and Sime Darby Berhad. Puan Nazifah holds a Bachelor of Science with Honours in Actual Science from University of Technology Mara and a CMSRL license. Our second speaker is Mr. Lee Chun Hong. He's the Chief Investment Officer, Equities from Principal Asset Management Berhad. He has more than 19 years of experience in fund management and equity research. He joined Principal Asset Management Berhad in 2017 to manage unit trust funds and institutional mandates covering Malaysia and ASEAN markets. Before that, he was attached to Libra Invest Berhad, managing and supervising unit trust and research divisions that cover ASEAN and China-Hong Kong markets. He commenced his career in fund management industry at Public Mutual Berhad. He had research responsibility for regional plantation and consumer sectors, as well as research country coverage of ASEAN markets. Subsequently, he moved on to portfolio management, specializing in ASEAN markets. He started covering ASEAN markets in 2010. He was also previously with PwC as an auditor. Chun Hong holds a Bachelor of Commerce, Accounting and Finance, Monash University, Clayton Campus. He's a CFA charter holder. Our final speaker is Brian Yeo. He joined RHB Islamic International Asset Management as a senior equity analyst in January 2021 and is currently covering the tech and EMS sectors for Malaysia coverage, Japan big cap stocks for the global coverage, and is actively managing the Sharia unit trust funds for the Islamic team. Before he joined asset management, as a sell-side analyst, he has won numerous awards and is often quoted interviewed by the press. Brian was a sell-side analyst with Affin Hwang Capital, where he covered the automotive, EMS, and plastic packaging sectors, respectively. He also has retail research background, where he oversees the Malaysian-listed small mid-cap stocks during his employment at Inter-Pacific Research. Brian graduated with a bachelor's degree in accounting and finance from the University of Queensland. Let's start with the first question. I think a lot of investors will be very interested to know whether the rally in the Chinese market will continue. Of course, we all see that China market as of September 2024 has become one of the top performing markets, right? With the Hang Seng Index advancing more than 24%, right? While the Shanghai Composite Index has also turned positive for the year with a 12% gain. Of course, recently we have seen some profit taking in the markets. To recall, towards the end of September, the Chinese government has announced a policy package that included a cut in policy rates, reserve requirement ratio, down payment ratio cut as well, mortgage interest rates, and the introduction of the two new tools aimed at directly supporting the stock market, share swap and financing for the share buybacks. So maybe we can ask Puan Nazifah, how does the current policy differ from the earlier ones that actually led to the sharp rally in the Chinese and Hong Kong equities?
Hi, Kim and everyone. Thank you for having me. Okay, the recent rally in the Hang Seng Index and also Shanghai Composite in the late September, it took about 1 month to reach, more than 35%. It was influenced by a mixed optimism and previous policy measures aimed at economic recovery. The earlier government, earlier the government focused on broader economic reform, such as transitioning towards a market-oriented economy, which allowed greater private sector involvement and attracted foreign investment. However, the current policy more direct and immediate measures to support the stock market. Um, I highlight here some of what the government do. One is the introduction of specific tools like share swap mechanism and financing for share buybacks and that directly addresses the market stability. The earlier policies were more generalized, focusing more on economic growth rather than immediate stock market intervention. The second one is kind of policy and ratio aim to inject liquidity urgent economy, which easing and however, the strategy also included cut, but they were not promptly directed at supporting equity markets. Examples are like, by lowering the benchmark interest rates, the government reduces the cost of borrowing. So this encourages banks to lend more freely and it makes loans cheaper for businesses and consumers. With a lower interest rate, businesses can invest in growth and expansion, and consumers may be more likely to purchase homes or make significant purchases. So this will stimulate economic activity. And by lowering the RR ratio, the banks are required to hold as reserves and not lend out so much previously. But by cutting the RRR, the government allows banks to free up more funds to lend to businesses, consumers, and also investors. So this increase uh, in available credit that can boost borrowing and spending, which can lead the overall economic growth. Other than that is the recent measures to alter down the down payment ratio for second home and mortgage interest rates represent a focused approach to manage the real estate sector's health, which contrasts with earlier broad economic measures. The policy measures announced recently by the Chinese government include targeted adjustment aimed at specifically at the housing sector. We see these adjustments are great to stabilize the real estate market, improve affordability, and encourage investment in this critical area of economy. Um, and then This adjustment aim to address the volatility in the housing market, ensuring the prices not to decline too sharply and also destabilize the economy. The real estate sector has been a significant contributor to China's overall economic growth. So stabilizing housing prices is crucial for maintaining economic balance. Another thing to highlight is the government has historically implemented policies to attract foreign investment. They established special economic zones with preferential treatment, tax incentive, and reducing barriers to entry. While these long-term strategies remain essential, the current measures signify a more urgent strategy to regenerate investors' confidence quickly. The investment climate refers to the overall environment for the country, encompassing factors that influence the decision to invest. In the context of China's recent policy measures and long-term strategies, the investment several key elements they aim to attract both domestic and also foreign investors. Um, And not to forget is the government also continuing to promote the digital economy with incentive for sectors like AI and e-commerce, which will also enhance foreign interest in investing within China. So by embracing these digital economies and also fostering the culture, of innovation, China aims to enhance productivity, also create new business opportunities, and establish itself as a global tech industries. So this focus on digital economy not only boost domestic growth but also position China to compete effectively on the international stage. So, and in a short note, that what the government currently doing that currently or they is technically they want to see an immediate impact to their economy, so that they can stabilize the economy will be faster, because what they are currently facing is quite tough for them, for China market. That's all from me, Kim.
Okay, thank you, Puan Nazifa, for the detailed summary on the monetary policy as well as the fiscal policy rolled out by the Chinese government. But Puan Nazifa, just now your video quality is a bit lagging, but your voice quality is still okay. Maybe later you can also
Okay.
check on your internet connection. Okay. Yeah, but we can catch you 99% of the information that you shared earlier. We can capture that. So a lot of analysts actually commented that despite rolling out such a big stimulus, but unfortunately, the announcement is actually lacking details in the eyes of the analysts, even though some analysts actually commented that the total package rollout is amounting to about 7.5 trillion renminbi. So, Mr. Chun Hong, moving on to, would you like to address the question whether you see the rally in the Chinese and Hong Kong equities will continue to rally, given that the policy direction in China, I think it's very clear, but probably the measures are not forceful enough. What's your thought? What's your opinion?
Okay, thanks, Kim. Hi everyone. Jun Hong here. So I won't go to detail that is been shared by Puan Nasifa earlier. So what I want to take to the audience that the background of the rally. First of all, you to be cognizant that the valuation of China market has been very depressed, partly because of the uncertainty on the policy since the COVID incidents. And also at the moment, so during the period from COVID until now, a lot of regulation are being targeted at business owner. And of course, as you all know that China have the toughest and strictest COVID lockdown in the world. And because of that, that affected not just the businessman and also affected the consumer confidence as well. Because of that, the valuation been depressed. And then the confidence is not there domestically. As you all know, that China market has been driven by retailer. If the retailer or the Chinese mainlander is not convinced the government can save the economy, they are not investing. So you can see how low is the sentiment in China. So that is to start with that. Second of all, this time around will be slightly different. If you follow the narrative that this Chinese government, this time around, they are coming with the term is they will do whatever it takes to save the economy. So something different. And in the past, you don't see a coordinated effort by the government. And this time around, a series of coordination by the government. And also, since Chinese New Year of 2024, you can see that for the first time, the presidency say that, equity market matters. So that set the tones for the equity market in China. Of course, subsequently, there wasn't any policy being announced. That's why the market been so off after that. And of course, because of this is the fourth year coming to the fifth year of the bear market and also the softness in the property market. I think the sentiment is just too low, and they are worried that they will turn into a next Japan, which they are quite concerned. That's why you can see that this time around they are much more focused on the stock market and also the people on the ground. Okay, and also according to my team, the presidency actually went down to one of the region and sat on the ground and talked to the people on the ground. And people on the ground actually tell them how bad the situation is. That's when the presidency, as a key man in the China, I mean, send down the tone and tell them they need to sort it out. And one of it, stock market is one of the equity, one of the KPI they need to focus on. So that's one thing. Second thing, valuation and also the coordinated effort by the government. Where else, as you mentioned, Kim, a lot of uncertainty, a lot of number being thrown around, 1 trillion, 2 trillion, 7 trillion, nobody knows. But again, based on the past history, we require at least 5 to 6% of the GDP stimulus to bring out the softness in the economy upwards. I mean, based on the last few matters, the last one was 2016. So with that, 5-6%, of course, like you mentioned, minimum is 7 trillion, if not 10 trillion, to bring things out of this bear market. Okay, so what we are watching out at the moment is whether they will pull it off, but at least the confidence is there. And based on that, after the serial announcement, the rally come, and then the confidence came. Instead of them traveling towards in their golden weeks, their national weeks or national days holiday, they actually stay back and open a margin account. But of course, things did not pan out as what they expected. But nonetheless, at least they set the tone, they set the floor. What you need to see whether the government is serious enough. We think they will announce something, but at the moment, because of we are entering the US presidential election in 2 weeks' time, of course, they will take time to push out some of the announcement. And it's good that we have healthy correction at the moment. If not, we, as a fund manager or as a CIO, we don't like to see one-way street up and then create a bubble and then nothing being announced and then the bubble bursts. So we think that this correction is healthy. I think they need to pace it out, the narrative, and then hopefully we can get a sustainable rally coming from here. So we are positive on China equity, but of course we are much more focused on the company that have a quality names and quality balance sheet than pass on the cost increase. So yeah, so those companies that can generate growth. So we are positive in the near term. But of course, like you mentioned, it's all hinges on the announcement by the government. Yeah.
Okay, thank you, Chun Hong, for the insightful sharing. So basically, what has actually driven up the market is mainly from the valuation, the cheap valuation, as well as the government support. But of course, maybe the corporate earnings must also catch up in order to support the market performance going forward. So, Brian, from a fund management perspective, do you think that investors should still allocate a certain amount into Chinese and Hong Kong market to capture some of the possible market potential within these markets?
Hi, Kim, and thank you to Phillip Cap for inviting RHB to speak on this session. Okay, in line with what Pan Azifa and also what Chun Hong mentioned earlier, given that what the Chinese government is putting emphasis in the stock market and also with all the stimulus packages, i.e. the rare one-off cash handouts and the subsidies for the poor, even including Shanghai also issuing a 500 million yuan in consumption voucher, we have tactically upgraded China to an overweight status, given the liquidity has started to already build up, right? This broad monetary stimulus is actually above the market expectation. So they have already, the Polyport Bureau also pledged they would likely boost the growth by halting the property rout, as what one just now mentioned, shoring up the stock market, as what Chun Hong also mentioned, and stabilizing the employment itself. While that being said, we are also a bit cautious in the way that they did not offer any specifics on the fiscal spending angle. The Ministry of Finance did indicate that the central government has still relatively large room to raise debt to weather this any possible uncertainties. So as they are holding out the meeting in September until the normally scheduled December, is showing a high urgency on the determination to support the economy, as what Chun Hong mentioned just now. Thanks.
Okay, thank you, Brian. So moving on to the second question, basically we see almost all markets that we track are performing well. US are now reaching all-time high, right? within Asia Pacific, I think China, Taiwan, most of the ASEAN markets are also doing quite well, probably with the exception of Korea. Puan Nazifa, as of September 30th, 2024, the Korea Kospi Index actually recorded a negative return of negative 2.3% year to date. So what account for the market underperformance? We probably, to the benefit of the audience, Korea is a tech-heavy market. The index, the heavyweights are mainly focusing on probably Samsung Electronics and SK Hynix. We are also the bigger weights in the benchmark itself. So, but we all know that the tech recovery has been ongoing. But what explains the underperformance of Korean market? Over to you, Puan Nazifa.
Okay. On Kospi market, there are several key factors have contributed to this decline. Geopolitical tensions, macroeconomic challenges, and also global market fluctuation. You see, on geopolitical tensions in the region, particularly relating to North Korea and their neighboring countries, these have created uncertainty, deterring both domestic and also foreign investors. Additionally, growing concern regarding inflation, interest rate hikes, and also potential for global recession have negatively influenced investor sentiment, which is contributing to market volatility and a decline in their stock valuations. Looking on their economy, South Korea's economy is heavily dependent on its technology sector, with major companies like, for example, Samsung and also SK Hynix, playing crucial roles in driving economic growth. Nevertheless, the recent decline in this sector have had a significant impact to the overall market performance. Looking at the reasons on this downturn was the global semiconductor market slump. And as a leading exporter of semicon, South Korea has faced challenges due to falling global demand for chips, influenced by inventory corrections and also reduced consumer electronic sales. And I think the ongoing tension, especially with North Korea, and the news recently, I think couple of weeks ago, have created uncertainty, investor confidence in technology stocks. The other reasons is I think common, the rising production costs because of this increased cost related to materials, labor, and also logistic. It did squeeze the profit margin of technology companies, and not to forget is the interest rate hikes previously, because with the rising interest rates globally, the cost of capital has increased, which affecting investment in technology and also innovation. Okay. In response to the challenging equity market conditions, I think the South Korean government may consider various interventions. We highlighted previously what China did to their countries, right? I think the same intervention, I think, need be done by the governments. Just to name a few, I think monetary policy adjustment. I think the Bank of Korea might lower the interest rate to stimulate the economic growth. And looking into the government, I think they need to look into the fiscal stimulus measures in enhancing the overall economic stability. So yeah, that's my thoughts on Kospi at the moment. Okay.
Thank you, Puan Nazifa. So it's a rounded explanation both from the external and internal factors. So, Mr. Chun Hong, within Asia Pacific markets, some markets are actually performing very well, but Korea, maybe in this case, are not performing very well. India also sees some profit taking off late. So, within Asia Pacific, which market do you think that investors should continue to position so that their portfolio could probably outperform the market as we approach the end of 2024 and into 2025?
Okay, so thanks for the question. I mean, in equity market, it's all about growth, where they can find growth, and also the the economic reform and also the government support. So like mentioned by Puan Nasifa, I mean, the things that the government need to do is, I mean, if you remember that Japanese have this program try to do is how to say, to forcing the government or the listed company to improve the governance and profitability.
Yep.
And also because of that, I mean, a lot of country try to follow. I mean, Korea have this value up program. And of course, I mean, the beginning of the year of 2024, I mean, on top of the AI team, I mean, the government came out with a value up program to imitate Japanese market, because Japanese market was one of the best performing in 2023. And actually in 2024, at one point before the yen carry trade unwound, also one of the best performing. So Korea was obviously tried to copy the same. But again, after that, the government is not serious enough and it's not very punitive compared to Japan. If the company did not deliver whatever they need to do, the Japan regulator actually put the company up in their website and name and shame the company. Whereas in Korea, no such thing, because of the chaebol is just too powerful in Korea. And so that's why the global investor kind of give up. That's the first stage of why the Korea underperformed. And subsequently, Samsung failed to meet the requirement of NVIDIA. I mean, in the beginning, we thought that Samsung, along with TSMC, can qualify for NVIDIA chips. But obviously, they failed. Only SK Hynix, they spent enough capex and R&D, and they qualified for it. That's why SK Hynix was one of the best performing stock until August, and have subsequently sold down because yen carry trade unbound. But after that, Hynix still outperformed Samsung because they continue to qualify for NVIDIA chips, where Samsung actually came out and apologized for the first time. I mean, coming from the biggest chaebol in Korea to come out and say sorry, it showed that how bad the condition is in Korea. Okay, so that's why stock will continue to go. I mean, investors will continue to plow into stock that can deliver growth. So Hynix is one of them. That's why Hynix, even though sold off, they continue to rebound subsequently because they continue to benefit from the AI team. Whereas the Asia Pac, besides China, that we think that valuation is cheap, there is room for recovery. We think the market should continue to be positive on Taiwan. I mean, because of Samsung, TSMC continue to be the dominant one. And of course, Intel, another Samsung story that failed to qualify and failed to come out with a chip that is as powerful as NVIDIA and the rest. So TSMC continue to benefit, and we follow a guidance earlier of this month. Demand is just too strong. Supply is just not enough. We don't have Samsung, we don't have Intel, okay, to balance it out. So beside Taiwan and China, I think one thing that we need to consider is, I mean, the past 2 years, the interest rate is on the way up, okay, driven by US and also the rest of the developed market. And since July, I mean, ever since the Fed and the central bank came out and indicate, okay, we have seen the peak of the interest rate, it's time to cut. So what they did, since August, Philippines the first one, I mean, emerging market, central bank, daring enough to cut before the Fed. And the Fed came in September and delivered bigger than expected rate cut, 25 bips to 50 bips. So that since then, the trend is going downwards beside Japan. So because of that, ASEAN will benefit. Like you mentioned earlier, India suffered a setback recently, partly because in the past, everyone chasing the growth. India is one of circular growth. Right now, because of the declining interest rate, less pressure on the emerging market currency. So money are flowing back to market that is cheaper, and there's room for the emerging market currency to appreciate. So ASEAN fit the bill. And also, beside the interest rate, ASEAN has suffered from political uncertainty. As you know, Malaysia is the first one. November 22nd, PMS came on board. I mean, we see the first rally in the ringgit, more than 5% in the month of November. And of course, subsequently, it came back because, I mean, uncertainty came back because nobody knows what PMX want to do. But after that, I mean, things has improved. I will touch on later. And then the next one would have election with Thailand in July 2023, and then Indonesia, February 2024. Vietnam also see some changes in the top. So that's why there's a lot of uncertainty for the past 3 years, beside the rising interest rate, weak ASEAN currency, political uncertainty. All these three factors has been reversed. So I think ASEAN fit the bill to be one of the market to be in for the next at least 6 months to 12 months. Malaysia, of course, I think is one of the best performing market in 2024. I think there's more room for that. So yeah, so beside China, Taiwan, ASEAN, and also Malaysia should fit the bill. Yeah.
Okay, thank you, Mr. Chun Hong, on your comments on the Asia Pacific region. Looks like the stars are aligned for equities, given the Fed rate cut and especially ASEAN when the interest rate policy direction globally have become more and more certain. Probably there will be more and more fund flows coming into the ASEAN region. I think a lot investors will concur that. So, Brian, within the Asia Pacific region, which market do you like and which market do you dislike and why?
Okay, thanks, Kim, for the question. Basically, we are pretty much in line with what Mr. Chung Hong just mentioned just now, pretty much where the fund flows are now coming back to Asia, ASEAN, where thanks to the better fund flows, we still like Malaysia because we think that it's still well positioned to benefit from the crucial link in terms of the data center play, as well as the tech relocation supply chain. And not only that, the continued employment and wage growth, which was also announced in the budget to increase the minimum wage to 2007 from 2005, is supportive of the household spending. Also, other segments wise, where we are still quite optimistic for Indonesia as well. Yes, Bank Indonesia cut rates before the Feds, and that could potentially see some reversal of the effects, which is sensitive to that aspect. But we see the populist measures may help to boost economy, and also not to forget a lot of the feedstock is actually fed into which will benefit from the China improvement as well also. However, in terms of ASEAN side, we are slightly underweight in Thailand side. Yes, they have the new PM, but we still see structural concerns remaining for them. And still, yes, it is, but we still think this concern remains. And also, much of the Value Park Fund and the e-wallet story has already been told. So we still need to see more fiscal policies to kickstart into 2025 to be more assertive of the market. Philippines side, yes, we are a bit more optimistic. It has cut rates ahead of Fed because of the FX pressure and also the inflation. We believe that the public investment spending would remain the key driver as government makes progress in infrastructure spending. Whereas for the rest, like Singapore, it still remain neutral, where Singapore banks will enjoy the tailwind from the higher margins of the US-linked rate environment. So we like the Singapore REITs, which has done well, and from the lower borrowing costs and the cap rates, tech exports are also seeing a pickup. So for the rest, like say Taiwan and Korea, we remain selective because Taiwan side, as what my other counterparts are saying, the earnings outlook remains quite healthy, with AI remains the key structural driver, with TSMC leading the pack, right? But we still a bit less comfortable on valuations, and we would prefer to pick up after correction. South Korea, as what Nazifah mentioned, the underperformance. That being said, we are still positive on the developments around the value up programs, respectively. That's all from my side. Thanks.
Okay, thank you, Brian, for your insights. I think we all like the information shared by Puan Nazifah, Mr. Chun Hong, as well as Mr. Brian. But a disclaimer here to be made to the audience that any information shared here doesn't construe any form of recommendation. Okay. Let's shift our focus to the US market. Puan Nazifah, it has continued to reach historically high levels. What factors are driving this outperformance, and do you think it will continue, especially when the outcome of presidential election remains uncertain?
Okay. On US equities, I think the outperformance can be attributed to there are several key factors because number one is technically on the economic side, the strong GDP growth and also recovery of labor market, which have bolstered investor confidence. This led to the higher stock prices. Number two is corporate earnings. You see, the corporate earnings, many companies have reported robust earnings given by growth in technology, healthcare, and also their consumer sectors. This has positively impacted the stock valuations. And number three is their monetary policy. They had announced the rate cut recently, and another 50 basis point is expected by end of this year, and then 100 by next year, and also 50 by the year after. So this continued accommodative monetary policy from the Fed, including this rate cutting and quantitative easing, this has made the equities more attractive compared to the fixed income investments. And then I think technology and innovation has fueled the stock performance because particularly among growth sectors that have dominated the market, looking at the big market capitalizations in the top 50, mostly dominated by the technology. So as to whether this outperformance will continue, I think there are factors that play a significant role. Nevertheless, on the presidential election, looking at during presidential elections, market rally. So we hope that it will continue. However, I think political uncertainty can lead also to market volatility. So I think investors may react to election polls, their policy proposal, and also potential outcomes, which may impact the market sentiments. And another thing is on the interest rate changes. The Fed adjust its policies in response to economic conditions. Rising interest rate could dampen the equity market performance or any delaying because they keep on giving, not to promise, but they have indicated that they may continue the rates cutting cycle. So if any delaying, it could dampen equity market performance, especially for growth stock that rely on low discount rates. Other than that is earnings growth, because continued corporate earning growth will be critical. Any significant downturn could lead to re-evaluation of stocks prices. So considering these factors, it is essential for investors to remain informed and also adaptable, keeping their eye on both economic indicators, political development, and also on the companies itself, especially as the election approaches. So I think diversifying investment may also help to mitigate their risks associated with market volatility during this uncertain period.
Okay, thank you, Puan Nazifah. So moving on to Chun Hong, what's your thought on the US market? What are the opportunities and the risks that we should be aware of?
Okay, so this market is a very interesting market. So first of all, I just bring you back what I said earlier. Equity market is all about growth, earnings growth. So the market or the fund flow or the money or investor would just follow any market would generate growth. If the market continue to generate decent growth, those markets will outperform those that are not generating growth or slower growth. So US continue to be one of the market that have the freest market that attract growth stock to be listed in US. I mean, US market is slightly different compared to, actually it's the opposite of China market. China market is mainly policy driven, whereas US market are mainly profit driven. Then second thing the most important thing is, I mean, beside the earnings growth, US market also enjoy from US dollar being the largest reserve currency. Okay, so that benefit both fixed income and also the equity market and other asset class as well. And also the other thing, what US has, that the rest of the market do not, we do have, but not as much as US, which is the depth of the US equity market. They have the deepest and most liquid market, whether it's fixed income or equity or any asset market. So as you know that investors, they love liquidity. They don't like to buy things and then they cannot get out. So US is one of the market they can get in and get out immediately. So that is also another plus for them. Okay, so growth coupled with being the most liquid market, US continue to attract the fund flow inside US market. If you track the ETF, only market that continue to attract inflow, US is one of them and one of the largest. So we reckon it will continue to do well as long as the company continue to grow and generate decent growth. Based on in regards of the US presidential election, so our team, our US principal team, based on their model, no matter which party wins or won, the impact is quite neutral in the longer term. But of course, in the near term, there will be a knee-jerk reaction in the immediate term. So the way the principal portfolio, they structure their portfolio, that is agnostic to any government policy for US market. So we tilted towards the company that can continue to generate sustainable and structural growth. So I think it could be noises, but nonetheless, unless the US economy enter into a recession, then yes, the valuation will give back some. But if not, we think that US market will continue to deliver a decent return. And also something that I mentioned earlier, the central bank around the world are cutting rate. So in the first time since COVID-19 that came in, all the central bank except Bank of China are on the easing mode. So we are on the global synchronized easing mode, means liquidity will come back. And where the money will go, again, they will chase growth. So any market can generate growth, will benefit from that. Yeah.
Yep. Thank you, Chun Hong. We hear you on the US growth story. Brian, moving on to you. So do you think that there's still potential for the US market?
Thanks, Kim. Okay, we do echo with also my counterparts as well also. We remain overweight in US, particularly because, as what my other counterparts mentioned, the economy actually grew at a slightly stronger pace in second quarter and initially reported. So like what Chun Hong said, growth is important. And we are seeing upward revisions to consumer spending, right? The GDP rose 3% annualized rate in the quarter, up by more than from 2.8% from the previous estimates. The personal spending itself also rose 2.9% versus the prior estimates of 2.3%. So all these upward revisions are showing confidence and stronger advancement of the purchases of goods and services and remains robust. The Atlanta Fed's GDP is now modeling third quarter growth at 3.2 SARR with better than expected US ISM services and employment. Unemployment itself normally is driven by the layoffs, but this time around we are seeing that it's actually because of the influx of people entering the labor workforce. It's a supply function and it's not a signal of recession. And to add on, the 50% basis cut, which was probably likely to keep US economy in a good place, should also keep the US market remains healthy in such manner. Probably something that I would also point out is that because of all these growth and also sustainability, there is seeing a big shift from a no landing position to a soft landing with a recession, US recession concern as a risk. As you mentioned just now, what are the other risks? Recession is one risk. Geopolitical conflicts is another risk. Inflationary pressure. Is there also potential systematic credit event? Is there an AI bubble, which we actually prefer? We prefer the big caps rather than the small cap stack because of the earning sustainability. And last but not least, the election sweep, which we also have the view that in the long run should not see a big impact to the overall market, but a knee-jerk effect as well. Back to you, Kim.
All right. Thank you, Brian, for your sharing. So we have pretty much covered the global side of things. Moving on to local. Puan Nazifah, we have just concluded our budget 2025. Are there any key interesting insights you think you'd like to share about the budget, and how should investors position themselves?
On budget 2025, I think you see already after the budget announcement, the market's reaction to the measures announced in the budget 2025 is likely to be muted because I think as the government embraces stricter fiscal consolidation while safeguarding the welfare of the people, on the agenda itself called Madani Economy, Empowering the People. I think this budget underscores the government's commitment to accelerate fiscal consolidation without imposing additional burdens on vulnerable groups. I think characterized as modestly expansionary, the third Madani budget features a lower deficit projected at 3.8%. This fiscal consolidation is premised on reduced public expenditure in 2025, supported by fiscal discipline that anticipates a stronger current account balance, thus fostering investor confidence in a stronger ringgit. On the tax reforms to enhance the revenue, we have seen to improve tax revenue in 2025, there are few tax policies are proposed, including a broader scope of sales and services tax (SST) and non-essential goods new tax and excise hike such as dividend tax on earnings above 100,000. Additionally, targeted rationalization around 95 subsidies is slated for mid-2025. With tax increases and subsidy adjustment primarily impacting influent group in the T15 category. I think on the group itself, on the T20, T10, M40 group or B40 group, I think the categorizations still being discussed by the netizens, given that what's been imposed, especially on the tax issues. Another things to highlight is on the fiscal management expectation. So in light of the budget implementation, this budget 2025 appears to adopt a less aggressive stance on addressing the fiscal deficit than previously expected. We believe that the government is prudent in its resource allocation, focusing on key economic sectors aligned with National Master Plan initiative. So we always this allocation anticipated to strengthen the foundation in the long term. Household for B40 and M40 income group may receive further assistance post-subsidy rationalization, while additional tax revenue and subsidy reductions are projected to mainly benefit T20 group. On the sector impact analysis, we did on sector impact analysis. The plan increase in the monthly minimum wage to 1,700 effective February 1st, 2025. Alongside an upsized cash handout is expected to boost consumer sector, though increased spending power. However, labor-intensive sectors may face challenges due to rising labor costs. Nonetheless, many workers in construction, property and technology or semicon sectors currently earn above 1,700, though cost pass-through arrangement. Renters will benefit from this higher CPO price threshold for windfall profit levies. Although I think on the consumer side, I think my news is likely to be negatively affected. Other than that, they announced on environmental incentive and also carbon tax. The government plan to introduce carbon tax in 2026, targeting on steel, iron, and also energy sectors. Revenue redirected towards funding green research and development program. I think this reflects the government's commitment to reducing greenhouse gas emission and also promoting cleaner energy sources. Anyway, the details on whether the policy will be mandatory or voluntarily remain unclear. And I think we think the implementation is expected to be gradual, starting with modest tax level. That's our thought from our internal. I think another sector that I want to highlight is on property sector outlook and also construction projects. Because pre-budget assessment for the property sector, I think has been, as budget 2025 provide limited incentive aside from the targeted tax relief on interest loans for first-time home buyers. I think, and then the absence of this anticipated initiative, such as the deposit grants on the extension for the home ownership campaign, and the Johor Singapore special economic zone, I think has dampened enthusiasm. The major projects are like the automated, the rapid transit, the Johor Bahru light rail transit, the LRT, as well as MRT3 and HSR missing from the budget announcement. So looking ahead, I think our internal strategy remain focused on positioning for a higher year-end closing. We maintain our year-end KLCI target at 1720. Influence our bullish outlook on higher quality stocks. So we anticipate that Malaysian equities will experience a commendable year-end uptrend, boosted by optimism regarding the China's economic recovery, soft landing in the US economy, and also eventual cyclical recovery in the tech sector. Furthermore, the sentiment is expected to be spurred by an array of these data center related land sales, significant IT project awards, and also M&A activities. So yeah, that's my take on the budget. Kim.
Okay, thank you, Puan Nazifa, for the detailed summary ranging from the subsidies as well as the tax. I think ultimately the goal is to improve the fiscal position of our Malaysia, to improve the Malaysia's fiscal position. So moving on to you, Chun Hong. Do you think the budget is in line with your expectation, or is not aligned with your expectation?
Yes, I won't go into the specific. I mean, Puan Nazifa already mentioned a lot. So we are encouraged by the continuity of fiscal reform agenda, higher provision of social assistance, which is something that, I mean, the P40 required, and also some degree of subsidies without compromising on development spending. But of course, expectation is one thing and reality is one thing. Okay? So yes, I mean, the expectation on the positive side, I mean, a lot of people talk about inheritance tax, wealth tax, a lot of kind of taxes to be introduced. Well, luckily it didn't come true, which is good because, I mean, we don't mind some taxes, but not too many taxes. We cannot cope. And also the businessmen who just don't know how to deal with it. And also with the implementation of e-invoicing continue until 2025, we are just adding more headache to the businessmen. Yeah, so that is one plus sign. But of course, like on the flip side, I mean, the easiest way to raise revenue through taxes is just through consumption tax. And then you don't need to expand your SST, increase your service tax, introduce more taxes. I mean, by introduce whether GST or other name you call it, I mean, would be good enough. I mean, tagging to 3,000, 4,000 mean income, I mean, not necessarily required. As you know, some of the country that is lower down, like Indonesia, already introduced value-added tax long time ago. Okay, so it's not something that we can't take it. It's just that how they approach the GST through the good exemption. Okay. However, that's more like what once mentioned earlier, more clarification required. How is this round 95 being carried out? And why is it June? I mean, hopefully come to June, they have the will to carry it out and not because of political instability or noises, and then they defer again, which is something that we are worried. Hopefully not. And of course, some of the things that like the 5%, 2% of the 100% dividend to individual, you are sending a wrong signal. I mean, people buy into dividend stock is for investment and saving purposes. I am not sure what kind of signal are being sent and whether it will discourage from investor from buying into high dividend stock, or maybe on the flip side, positive side, I mean, it will force them to switch into Amanah Shaham or unit trust income. Okay, that could be a positive side, but let's wait for the more clarity. But overall, how we see the budget is this is just to boost the domestic consumption. I mean, the minimum salary hike to coincide with the civil servant salary hike in December, and then more cash hand out. All that is just to induce more consumption. Okay, so that is good. But of course, you could argue on the other side. I mean, 1,500 to 1,700 will hurt some of the SME and also low-end manufacturing. But you take a longer term view, I mean, it's a good thing. They kind of force it. I mean, the company to be more creative or more innovative. How you going to automate your system or push your value higher up and higher margin product instead of focusing too much on the low-end manufacturing that will hit you eventually. Like what happened in Thailand right now, all this low-end manufacturing, they cannot survive anymore. Not just Thailand, Vietnam, like the textile. I mean, you can't compete with the people like Bangladeshi or the South Asian nation because, I mean, they have not moved up the GDP per capita, whereas Vietnam has moved up, Indonesia moved up. You need to move up with the trend. If you continue to just focus on the low-end manufacturing, you will just continue to be a low-end manufacturing economy. So on the longer term, it's good and positive. But overall, we think this budget is a people-friendly budget and domestic oriented company or sector will benefit in the near term. And of course, I mean, with the declining interest rate means the currency weakness in ASEAN, including Malaysia, will be less so. And because of that, exporter might not benefit in the near term because exporter prefer weaker US dollars. Importer, on the flip side, they prefer stronger dollars. But as you know, Malaysia, more than 60% are domestic-driven economy. So technically, we are more of an importer than exporter. So we need to be quite clear where you want to put your money in. So at the moment, the trend is towards a stronger ringgit. So domestic names should perform better in the next 6 months to 12 months. Yeah, that's how we see the budget. But of course, we need to wait and see what's more being shared with the government by the government. Yeah.
Yep, agree with Mr. Chun Hong. Budget is just the first step. The ultimate step is to monitor the execution by the government. Moving on to you, Brian. What's your thought on budget and how should we position from this budget?
Thanks, Kim. So I agree with Chun Hong that this budget is a people-friendly budget, right? And we believe that this budget 2025, like my other peers here mentioned, is focusing more on the gradual reforms while remain supportive of growth, fiscal consolidation, and also something that my colleagues, my peers didn't mention was to also spur some investments via the public investment incentives to stimulate private investment. Sorry. For instance, the what do you call the incentivize to introduce several incentives to encourage investment in the high value sectors for the IC design and tax deduction for digital technology like AI, robotics, IoT, data science, and finance technology from the likes of Khazanah, right? Also, the sustained elevated DE at 86 billion still remains healthy for the construction sector, but is more state-focused rather than a broad-based mega infrastructure like the past, right? Also, another point that we also are in line, which is to seek further clarity in certain of the measures, i.e. the carbon tax, right? And also the broadening of the tax uh, coverage in the scope, especially in premium goods like your salmon, avocados, right? And what other products will be part of this basket itself. And also something to mention is the EPF contribution from the foreign workers may also, we need to find more clarity on that part. Will it dampen the pockets of the businessmen or the GLCs? So that's another segment that we are also looking forward to hear from the government. Overall, we are in view that this is slight negative to the corporate earnings in the near term, but that is no big negative surprises in this budget. And we remain positive for the local market, fueled by the healthy economy and also the improving external factors, the fiscal structure reforms, and also the ongoing initiatives to encourage the foreign exchange flows and also support the ringgit and index. Also, just a side note, the news just came out, that Malaysia is part of BRICS now with the other 12 other countries. Yeah, there's a surprising thing to highlight on the side note. Thanks. Back to you,
All
Kim.
right. Thank you, Brian, for the sharing. So before we end the session, maybe I think we can also engage with Puan Azifah from BIB Invest, Mr. Lee Chun Hong from Principal Asset Management, as well as Mr. Brian Yeo from RHB Islamic Asset Management on the product recommendation. Probably we can start from Puan Azifah.
Okay, I think we have heard from these two speakers, Mr. Brian and Mr. Chun Hong, on the budget. We discussed in detail what's happened in Korea and also China and also US. Despite these promising factors that could potentially support the continuation of this market rally, I think from our side, there are significant underlying risks that investors should be mindful of. One major concern is overvaluation, as the significant outperformance of a few stocks may lead to inflated valuations, making these stocks susceptible to sharp corrections. Given the high concentration and the market reliance on a mere handful of stocks, I would recommend investors can consider diversifying their portfolio by including equal weight index exposure. So this strategy has the potential to minimize downside risk in the event of a significant momentum reversal while still participating as market continue to move up. So in the IMB investment management, we do offer a few global equal weight funds to provide investors with risk control when reversals happen. So one of them is our BIMB, our flagship product, BIMB Arabesque Global Dividend Fund 1, which is the only Syariah ESG fund in Malaysia, which gives dividends of 5 to 6% per annum. So another product to highlight is I would like to recommend our in-house fund, which this is a balanced fund, BIMB Dana Al-Munsif. Al-Munsif is the only balanced fund by BIMB Investment. This is suitable for investors who are looking for a mix of growth and also income. And this fund typically invests in a combination of stocks and bonds. And this fund currently giving this is a balanced fund, still giving a good commendable return. Year-to-date total return is at 13.4% year-to-date. If you are interested with our product, please contact our sales reps for details. That's all from me, Kim.
All right. Thank you, Puan Azifah. Over to you, Mr. Chun Hong.
Oh, thanks, Kim. So let's mention we are positive on the global equity market, ASEAN space, and also the Asia Pac and Malaysia as well. So because we are, as mentioned earlier, equity market generally perform better when the global interest rate is on the way down on the synchronized manners. And provided no recession, we don't see any risk at the moment. Usually you will require a crisis to trigger a global recession. So what do we like? I mean, on the thematic base, we continue to like Principal Global Tech Fund and also Principal Darling Global Fund that, I mean, will continue to enjoy on the healthy growth. And closer to home, because of where the positioning is right now, and with the risk to the upside in China market, we also like Principal Asia Pacific Dynamic Income Fund. So this is one of our flagship fund. And of course, nearer will be Principal ASEAN Dynamic Fund. So this one, I mean, generally, ASEAN will perform best when the currency do not depreciate against US dollar. So we have passed that, and political uncertainty is only now a tailwind. So ASEAN is poised for a better performing market. And lastly, on Malaysia, I think we'll continue to do well. I think 2025 will be even in
Sorry, Chun Hong, you are breaking.
small cap funds and also Principal Small Cap Fund for conventional. And the other fund that has continued to gain a lot of interest lately will be our Principal Islamic Malaysia Opportunity Fund. So for those investors that prefer a lower beta fund or lower volatility, we'll recommend Principal Major Titan Fund and also Principal Lifetime Balance Funds. So most of these funds are ranked the top 2 quartile on the Lipper ranking. Yeah, that's all. Thanks.
All right. Thank you, Mr. Chun Hong. Finally, over to you, Brian.
Thanks, Kim. I guess the most important part of the whole presentation, if you remember me, remember Dana Islam. So basically, this is a fund that taps into the Malaysia growth story, backed by the strong policy reforms I mentioned early on, the ringgit strengthening plays, the data center investments, and also the significant infrastructure build-out will benefit this fund, right? And we believe that we should take part in the Malaysia Madani journey. This is actually a dynamic fund where we will have conviction stock picks of 30 to 40 names. It is ESG friendly and also Sharia compliant. We go through thorough Sharia screening for this fund itself. And more importantly, this fund is actually in a top quartile over the 3-year basis. And to seek for alpha, we can also invest up to 30% foreign exposure to seek these opportunities. Yeah, so overall, we like the overall themes, i.e., the data center plays, the Penang, Sarawak, Johor plays, right? Tourism plays, the Fed cut rates, and also the rising FDI / the US-China tech war beneficiaries. Yeah, so Dana Islam is a fund that I wish to promote to whoever's listening over there. Back to you, Kim.
All right. Thank you, Mr. Brian. So I think we can wrap our session. Thank you so much to Puan Nazifah, the Head of Equity Investment from BIMB Investment Management Berhad, Mr. Lee Chun Hong, Chief Investment Officer, Equities from Principal Asset Management Berhad, as well as Brian Yeo, Senior Equity Analyst, RHB Islamic International Asset Management Berhad, for joining our Phillip Roundtable today. That's all for today. Thank you so much for dialing in. This update is brought to you by Phillip Capital, your partner in finance. Thank you.
Thank you. All the best.